G'day expats, ladies and gentlemen. Welcome to another episode of the Expat Mortgage Podcast. As always, I'm joined with my co-host, Jeremy Harper. Good afternoon, mate. How are you?
Good afternoon, James. Very good for a Friday. We are leading into the June RBA meeting, so we've got a bit of data to unpack before the next meeting.
Yeah, absolutely. And gosh, it's what a change in the property market since the budget only a couple of weeks ago. And we're already seeing some of the impacts hitting a lot of different markets. And I think we can unpack that today. We've got obviously that totality report that shot out early June, getting the read on the May figures.
Yes.
What was your takeaway from that National Home Value Index report?
So yeah, as it's been sort of in the works for a couple of months now, you can see Sydney and Melbourne are now in a bit of a downtrend at the moment.
Yep.
So you can see for the month of May, Sydney came off 0.9%.
Yep.
And Melbourne 0.8% for the month of May. So if you look at their 12-month average, we're now looking at about 4% growth for Sydney and about 2% for Melbourne.
Yep.
So they've both come off about 2 to 2.9% off their peaks back in November 25.
Yeah, I can see that. And remarkably, you look at still Brisbane market, Perth, they're just running. They are just running. So you're still seeing a fractured property market at the moment whereby some capital cities are still running consistently. You look at Brisbane, Adelaide, Perth. I don't like Perth as an investment market, to be honest, but I'll bite my tongue. Darwin's an odd one as well. It's not somewhere I'd probably invest, but you get a lot of value there for what you spend. And nationally, 8.8%. So overall, that's still pretty strong, I'd say. 8.8%, 12 months of May, that's pretty good. I think probably the next 6 months are going to be really interesting. I think you'll see those figures start to pull back a bit. You're hearing property economists sort of say, yep, we're probably going to see, obviously, a correction on the property market. Some are saying, the biggest correction in the 40-year period, but the biggest correction that we've had in the 40 years, I think, was about in 12 months, property pulled back about 8 to 9%. So we're not talking 20, 30, 40% in prices being cut. It's something maybe around that where the property market really does stagnate for a period until a lot more is known about the proposed budget measures.
Yeah, and that's reflected in the clearance rate. So Sydney's final clearance rate for May was 49%. So that's the lowest since April 2020. And Melbourne was 54%. So around the same, which again, lowest since July 22. So going back to those COVID days. And I think that's sort of like a leading indication to say, okay, it's definitely turned to a buyer's market in those two big cities. I've got buyers now who are picking up some great deals, great own OC deals where perhaps the vendor, I've had some stories where the agents sort of overpromised the vendor at the start of the year and now they've had to come back to the market and sort of click back the sale price. So the market's definitely a buyer's market out there. So, if you're in that position, definitely take advantage of this.
Yeah, absolutely. And I wonder if we'll see towards the back of this year, next year, some more maybe distress sales. Obviously, this time of the year, as we move into winter, the property market does cool off a bit, and it's the same with the rental market as well. You see less of these things. So in terms of the sheer volume, we're still following that same trend, but it's now exacerbated by the fact that we've just had a very punitive budget. With regards to the budget, next week will actually be very telling because the Senate reviews and votes and debates the CGT changes and the negative gearing changes. They're only allowed 2 days for that debate, which is remarkable. The largest tax reform in 30 years, and they've given us 2 days to debate it. Tells you about the government, doesn't it? And their obviously goal is to have it legislated by the 2nd of July to give clarity, and then later in the year we'll get those other draft legislation pieces around the trust district and family trust and other things. But definitely seeing the volumes come off a lot less. I think if we just pick out some more here year on year, year on year, you look at the markets that are doing well there. Perth's up 22% in terms of volume of listings.
Hmm.
Canberra surprisingly is up as well, 48.5% on the volume listings. Brisbane makes sense, 25.5, Darwin 23.7. So you got those capital city markets that have been running really strongly, still having year-on-year growth in terms of the
Yep.
volume. I'm sure we could probably drill down on further numbers there. Is that things which is off the plan in a lot of those capital cities, or is it sort of existing properties?
Yep.
Rental vacancies. What's your thoughts on that?
Yeah, it's still incredibly tight. So obviously lack of stock available for the renters out there. So
Mm.
national vacancies now sitting at 1.5%. So it's back in
Wow.
line with the record lows.
Yep.
And it's half the decade average, which was 3.2%. And so some of those smaller markets like Hobart, Perth, Adelaide, Darwin are sitting at sub 1%.
That's incredibly tight. And I mean that just goes to show that if you're a renter, like it is such a tough market. You've got to be pretty lucky to actually snap up a good rental, and then you've got to just
Yep,
hold on to it for as long as
exactly.
possible.
Yep,
Um, that's remarkable how tight that is.
yep. And advertised rents now, they are running at 5.9% on annual growth.
Yeah. Well, the concern was after that budget, and you saw it happen over in New Zealand by removing negative gearing, tweaking the CGT changes, especially negative gearing, rents often soared quite significantly.
Yep.
Um, and they did it twice, I believe, in New Zealand across the last 30 years. The changes in negative gearing, they took it out, they brought it back in, they took it out, they brought it back in. So we'll just have to see what happens on the Australian side. But if rents obviously track up very aggressively, the next government will have to certainly repeal a lot of that legislation very quickly.
Definitely, definitely. Yep. So, and some of those listings are down, which it's just going to put more pressure on that segment. So over
Yep.
to interest rates, because it's been interesting. There's
Yep.
been a fair bit of movement really recently in the last sort of
Mm.
2 weeks. So a
Yep.
couple of things have caught my eye. Obviously, we've got the RBA meeting next month. We know the cash rate's at 4.35%.
Hmm.
But a couple of things have caught my eye. ANZ and Macquarie have actually sort of cut some of their fixed rates recently. Not huge
Hmm.
amounts, but
Yep.
just little bits, which sort
Hmm.
of, up until then, all the major banks had been increasing their fixed rates. So I find that quite interesting. First Mac, which is more of an investor bank, has come out and they've taken 30 points off all their loans for new
Yep.
lenders or for new
Yep.
borrowers to make. So that sort of gives me a bit of sign of where perhaps there's room to grow or room in terms of the margins and what's cost to borrow for some of these banks.
Mm.
And then finally, the NAB economists came out and said, look, they now think that the next RBA movement is going to be a cut.
Yeah, I think that sort of that gained a lot of traction in a lot of news media outlets that they think it's going to be a cut. But I think it's probably important to temper expectations
Yeah.
there that the RBA meeting next couple of weeks, next week, we probably are very unlikely to see a cut. I haven't even actually looked at the ASX rate tracker at the moment, but Jeremy's pulling it up right now in the background. But I know that we've just got to be mindful that we still haven't got the June quarter figures because we're still in June. But remember, this is the quarter in which a lot of that inflationary impact from the Middle East is going to be really hitting us. So
Mm.
it wouldn't be a surprise if the inflation figure that comes out from the June quarter is tracking around 6%. That actually wouldn't be out of the norm because obviously cash rate has gone up through that period. It takes a little while to feed into the economy and start unwinding a little bit. So I don't think we'll see a rate cut if we were to see a rate cut till much later in the year, probably like the
Mm.
last sort of decision of the year, because they need to let the current interest rate have an impact on everyone's
Yeah.
spending.
Yeah. Yeah. Yes. It's really interesting because this is moving so quickly. And I think if we go back to some of our early episodes, we said, what if the market moves before this budget? And I thought the budget was going to have more assistance, but it's actually
Mm.
gone the opposite way. What happens if we get to the end of the year and, unemployment's tracked from what, nearly flat four to mid fours, if it's near 5%, and then if
5% scary. Yep.
we know the RBA is looking at property prices, if property prices come off at the end of the year by say 5%, will they abandon their goal of this
2 to 3.
inflation goal of 2 to 3%? Because
Mm.
they've never really hit it, have they? Recently, they haven't really kept us in band.
Oh, it's just because they cut too quickly, I think. We did briefly hit it, but then it went up pretty quickly. So I think the lesson they learned there, they just cut too aggressively. Um, and I think it's probably realistic to expect property market just really sidesteps this year. Bit of pullback in some of those capital cities maybe, but
Mm.
materially, not much. Like you're not going to be going into a property that's priced at 2 million today, and then fast forward towards the end of the year, it's priced at 1.5 million or something. We're not going to see that. It might be 2 million now, and then the vendor might be releasing it for 1.9. A bit of a vendor
Yeah.
discount there of 4 to 5% maybe if it's a distressed sale, but
Yeah.
probably also see a lot of people just holding tight.
Yep. Holding tight. That's right. Utilizing those offset accounts.
Yep. Yep. And then what's the ASX rate tracker saying at the moment?
Oh,
What's
they've
it
got 100% certainty of it just keeping as it is,
on hold?
of a
Yep.
hold.
Yep.
Yep. So
Yep. Have to wait and see then. Well, I mean, why don't we pivot now to a bit of Q&A from the listeners?
yes,
Yep.
yes.
Yep. So if you do have any questions, there is a form in the show notes. Just jump on there. You can submit your questions, and we're happy to run them through. A lot of these questions is mainly me asking Jeremy because he's the finance guru. Let's jump into it. Question one, good question. I feel like we might have discussed it a little bit, but should I wait for prices to fall further before buying back home? So obviously, it sounds like an Australian expat living overseas,
Yeah.
potentially looking to break into the market back in Australia to buy maybe a future home. I mean, what's your read on that one?
I mean, you can never time these things. So
No.
it comes down to your personal goals and are you ready?
Yep.
You could probably jump in here around the AUD and what that's been doing the last couple of months just recently because there's been a bit of movement there.
Yeah, last couple of weeks even. So it was tracking up towards 71, 72, and even 73 cents.
Yeah.
Um, and a lot of that was just centered around our cash rate going up against the US dollar. But not only that, our commodities, a lot of our natural exports being in high demand, but also priced really well. So when you have that happening, there's a greater demand for Australian dollars because people are buying more from us. But you've also got the currency doing strong because of our RBA cash rate. Now, more recently, there's evidence to suggest that maybe there might be a rate increase over in the US. So we've actually seen the currency drop back from where it was, 72, 73 cents to about 70 cents at the moment, because now there's a bit of an expectation baked in the market that maybe we might see the FOMC, the US Federal Reserve, go up and increase the interest rate over there, which means that adds value to the US dollar. So um, that's what's been tracking the last sort of couple of months around the
Hmm.
AUD versus the US dollar. But no one can time these things. We always recommend that dollar cost averaging approach if you're living and working overseas, sending money back, reinvesting it, whether it's property, shares, super, paying off debt, sitting in your offset account so you're good to go. If you're looking at sort of the capital cities, Sydney and Melbourne, they're probably the slower markets right now, but you're not going to see massive discounts. We're not talking about 10, 15, 20%. You might be able to pick up a deal where you get a vendor discount at maybe up to 5%, maybe, but definitely a lot less volume in those markets at the moment. So you might have better pricing or purchasing power in the next couple of months should things worsen. But timing is just such a hard one. If it's right now
Yeah.
and it suits your circumstances, you got the pre-approval, then go shopping, see if you can find something suitable.
Correct. Particularly if, the USD and
Yeah.
denominated and paired up currencies have strengthened against Aussie, that Australian debt or purchase now looks a bit more affordable. So
Yep.
use that to your advantage.
Absolutely. Yep. Question two is centered around rental. If prices are soft, is it still worth buying an investment property? Absolutely.
Absolutely. Yeah. I mean, the yield the yield as a percentage will look stronger.
Yep.
As we said earlier, the vacancy rates, sub 1.5% nationally, and that's
Mm.
pushing up rents. So that's going to put more pressure on that really to get it to
Yep.
price up
Yep.
potential investors to say, take that on. Here's a high yield. So
Yeah,
yes.
absolutely. And I mean, remember, when you're buying an investment property, it's a long-term hold. We're talking 10 plus years here to accumulate wealth in. Right now, because it is moving into winter or in winter right now, you see a lot less volume. And that even comes down to when you're listing a new rental and getting a new renter in there. compared to your spring and summer season, you might be on market for a few more weeks, and there's less applications coming in because a lot of the volume happens in those sort of warmer months. It's just this seasonal shift that we often see. So you'll be able to rent it out, and there is a housing crisis, there is a rental crisis. The national vacancy is 1.5%, so you'll rent it out.
Yeah.
But right now there's just usually a lot less heat in the market. But yeah, right now as prices drop and people get a bit nervous, this is when you need to be greedy. Be greedy when others are fearful. Be fearful when others are greedy. Yeah,
Yeah.
on the reverse
Got
side
that the
there.
right way around.
Yeah,
Yep.
yeah, it was like Warren Buffett saying. And we could certainly apply that to some different asset classes right now. But yeah, good time. Absolutely.
Yep. I agree.
Another question here sending around what's going on the rate markets. So fixed or variable right now? What's your take, Jeremy? What would you be doing? Or I guess feedback on the current rates that are out there at the moment.
Well, I think right now the fixed seem to be at their peak in terms of pricing. So really, again, it comes down to how comfortable you are with having a variable loan. Some people, expats over in the US, they hate the idea of sort of a mortgage that can move all the time. They love a fixed. You can take a portion, you can split a loan into fixed and variable. It really comes down to your goals. Like, are you comfortable potentially having a higher mortgage with the variable, or it could go backwards?
Yep.
This market is moving very quickly. It wasn't that long ago Westpac was saying they were pricing another 3 hikes this year. And now you've got NAB saying the next one might be a cut. So it's the economists are constantly changing their forecasts. And it's just a matter of your risk profile. Are you potentially okay if it goes up a little bit, then keep it a variable. But if you need that certainty of the repayment, then look at fixed. But on the other side of that is just understand that you may lock yourself into a fixed rate that
Premium.
if there's a cutting cycle, you're now locked into a higher interest rate. And nobody likes that.
No, and I think, the way that you could manage that is if you're just unsure right now, maybe a fixed rate for 1 year makes sense.
Correct.
You're not going to probably lose out or miss out on too much there if rates come down. Rates shouldn't come down too aggressively. Remember, we've still got the nasty inflation figure to come out in June. RBA has to take that into account. So if there is ever going to be cutting, it's likely going to be towards the end of the year. So that means you look like a genius for the next 6 months. But then you might be paying a premium for 6 months
Correct.
after that, and then you ride the variable wave. No one has that crystal ball, but if you prefer certainty that your repayments aren't going to change for at least 12 months, fixed might be the best play there.
Yep. Good call.
Sensible question. Good question there. I mean, any updates from you, Jeremy, on what you're seeing in terms of fixed rates or variable rates, how they're priced at the moment from some of the major lenders?
I mean, I did see on discounting the banks were pulling back a little bit a couple of weeks ago. That seems to be softening up a little bit more. I just get that feeling that the cost of funding pressures is not as acute for some of these banks as it was maybe 5 or 6 weeks ago.
Yep.
So that probably explains perhaps what's happening a little bit in the US market as well.
Yep. Yeah. Okay. Interesting. Gosh, it's just an interesting market, isn't it? Right now, you've got such a divide between asset classes and how they're performing. Share markets. You've got inflation running hot. You've got the cash rate up pretty high when you look at the 15-year average of the RBA cash rate. You've got the property market in some areas still running pretty well, some of those capital cities, which is going to slow down right now. But then you've also got so many investors just holding their breath on how these budget measures that were announced are going to roll through. Again, we're not going to see much from the trust side until later in the year, but CGT discount, the negative gearing, we'll know more about that by the end of next week. So hold on and we'll give you an update next week.
Looking forward to it.
Beautiful. Well, guys, thanks for tuning in on another episode. Thanks for your time, Jeremy, and see you on the next episode.
Thanks, James. Thanks, guys.